the KPIs that we're going to be reporting on, because this is the Tower of Babel here. We all talk, we have so many parameters and so many definitions, and even within the ESG community, we're so divided into, is it SI, is it SRI, is it ESG, is it, let's debate the terms. Let's start rationalizing this and focusing on what are the key drivers.
Yeah. We'll come to this later on again, but just one element of the SRI is, or one segment of the SRI market is one who wants to have a direct impact. We just have one question to that because it's fairly interesting, because it wants to have a direct positive impact on society and environment. And the market is seems to be quite big at 8.7 billion euros. This is the estimation of URSIF. And half of the high net worth individuals are already investing in URSIF, announced yesterday. So do you think, Amy, that this segment will probably grow faster than the ESG liquid products? And that
there certainly is a lot of momentum at present toward the less liquid or illiquid investing side, where a lot of people, both when they use the phrase high impact, are implying less liquid more than the liquid side. I'm not sure that I would call that driven by interest in socially responsible. I mean, several forces are coming together in that. One is that is a reflection of markets at large. When I set out in investing, you were average portfolio, 35% liquid bonds, 65% liquid stocks. Now you are average U.S. portfolio. I mean, you tell probably 35% domestic equity. I'm on a board that's 17% domestic equity. You're running up at 40% illiquid. So against that backdrop, I'm not sure that illiquid and social investing has a particular statement in and of itself. I think it's more a reflection maybe of what's going on. But there's a component of each individual likes to take a sense that they've put. I'm more of a systems changer. So myself, I'd like to see. I think the simple answer to your question is to price externalities. Not to say whether it's this externality or that externality, but have some externality and then price the externalities. To go for the big picture standards. And I think that there's an appeal for an awful lot of people to go to the one thing where they can say, I was part of the process of making the device that brought clean water to 6 million people. And that capacity to have funded that company that did that thing is more of a driver than a systems interest.
Yeah. So then, on this background, it's the question, what was the effect of financial crisis to the market is probably not really important if you see it in the long run. Valéry, how would you say, what was the effect and is it important?
Well, I think the financial crisis was, anyway, a big negative effect because the collection...
On the whole world, yeah. I mean, now to the SRI market, what was...
But I think the effect was remember what happened in the UK in the last 18 months. Some of the big asset managers decided to close their teams or to outsource the teams not because they did not believe anymore in sustainability, but simply because they said, well, we didn't collect enough. As you said, Giampiero is new classification, we just reclassify the fund, but where is the pure SRI money flowing into the fund? It's not that easy to collect. So some people decided that because of the crisis, because of the cost, they did their job, they did the management review, and okay, it's costly, let's put this money out of the process. Let's routine only for specialized asset managers.
So it was more the negative effect. I mean, if you see the financial crisis, you say, well, the reason are non-responsible behavior in economy, so it should have given a really big impulse to the SRI market, but apparently it didn't.
You know, it was a very difficult time for. We have positive effects, negative effects. Positive effects, a lot of people said, well, it's time for a change, for a big change. It's a game changer. This crisis is a game changer. Let's look at the financial picture. Let's revolutionize the world. Let's change the way banks finance the economy. So to make sense, we came back to the roots of finance as just financing the economy. In the meantime, how much changed, it's not that easy to say, and how much SRI brought in terms of change, honestly, maybe not that much. Maybe not
But in your country, the same.
I would say that the financial crisis, absolutely, financial crisis is a game changer, but it's a game changer in a lot of ways. And I think that part of the driver there, as we looked at it, is the idea that you cannot quantitatively just look at investments, that the qualitative components create risk. And part of that goes back to what we talked about in the beginning, and that is that data is important, but data is limited by where you draw the data. We can have an entire sidebar conversation about the limitations in data, where we all think it's representing because we named it something, but it not necessarily is that. It is the limitations on collecting the data. I think that the financial crisis, the global recession, creates a really different economy that's been happening over time, which makes ESG investing rational, has been rational, and becomes more rational. We see both globalization, so we see an expansion of markets, but we also see a desegregation of markets. So as you see more private equity coming in, infrastructure finance, kind of these new products, but have actually been around, I think you're seeing that a more consciously managed fund, not magically, is more important in the coming years, not less important. And I think it opens up unique opportunities for ESG, for those that weren't believing previously.
Yeah, I would tend to agree absolutely with that. I think that the time change on that is, we can't see today the benefits of the financial crisis on ESG. It's too early.
Right.
So, but we will see it over time, because I think that what it's introducing is an element that basically pure financial or greed, as was debate that was introduced this morning, is not enough. And therefore will not take you on a through cycle performance measurement. And therefore, I'm seeing many more family offices, many more of the sort of the high net worth and ultra high investors that are basically saying, look, if I'm basically taking at the risk end of the curve and investing in that arena, I might as well do it in something that basically, if I get disappointed, or I may have the risk of being disappointed on the financial return, rather than pursuing the marginal financial return, let me try and do something that makes me at least feel good. Bringing the water, clean water to that sort of community, etc. So at the end, the financial crisis is basically proving that the short-term orientation is not enough. And you can't just go for short-term greed.
Do you share, Toni, the opinion that in the future investors won't look at responsible companies, but won't invest at non-responsible companies?
Well, I think partially that would be maybe a little too optimistic. But I think more, I think that governments and populations, we just came through an election successfully, in my opinion, in the United States, and where you see this really desegregated, you see the 1% and the 99%. So we spent a lot of time on that in the US, where companies that have high levels of externalities is much more consciously known within the electorate in the United States and talked about than it was, say, 5 years ago. So I think that we will be looking at good corporate players, bad corporate players, who are we, I think now more, not just among the geeks that I might talk to, but I think more generally we know even asset managers that perhaps are associated with companies that don't do very well. That's becoming more well known. So I think that the